Defense stocks are the topic of today's presentation, in particular RTX stock. And I was quite surprised to see that RTX Corporation is now what Raytheon calls itself. I've always known, I'm sure as many investors who eyeball the defense, Raytheon. So I'm going to refer to RTX as Raytheon throughout this presentation, just because that's a name that's familiar to me. Now, reasons we're interested in Raytheon. First of all, the people who pay our bills have asked us to cover this. So we have a Discord server that's exclusive to paying subscribers. Those are people who have subscribed to Nanalyze Premium, whether that's annual or monthly. And in that forum, we discuss stocks. And quite a few people have asked for us to cover Raytheon, both in email and in that forum. I think that's because it's a relatively popular stock with a very intuitive thesis. So war equals profits, and we see a lot of that lately. And the reason that it's on our radar is that it's a dividend champion in our Quantigens strategy, and I'm going to talk a little bit more about that later. But I first wanted to look at the aerospace and defense sector, and here's the GICS classification on Wikipedia. So we've talked about this. It's the Global Industry Classification Standard, and it's a way that you can describe what companies do. So every publicly traded stock has been assigned a classification, and we can read down. It's rather cool how this tree works. You see it starts at industrial, so there's 11 industries, and one of those is industrials, and then it goes down the list to capital goods, and then aerospace and defense. That's where Raytheon would belong, and a handful, I'll say more than a handful of other companies. And to get an idea of what names exist there, we can look at ETFs. That's a great way to see what's in a particular classification. And here I've pulled up the iShares U.S. Aerospace and Defense ETF, and it's the largest, has over $5 billion in assets right now. But when you look at what it's benchmarked against, you see Dow Jones U.S. Select Aerospace and Defense Index. That's different from GICS, so we're going to take a look at that in a second. But look at the weightings here. So we have RTX, Raytheon there at the top with an 18% weighting, Boeing under that 16%. And anyone who knows anything about these companies will wonder why there's such a heavy weighting there. And I don't know the answer to that. You'd then need to dig into the methodology and see why. We're going to look at another ETF here in a second that's more equally weighted, but I wanted to point out the difference between GICS structure and DJICS system. You could see they're quite different, right? So generally you'll find, I think GICS is the most popular, but you'll find these used interchangeably. And what you'll also find are companies that just create their own indices, and you have this is the second largest aerospace and defense ETF from Invesco. You can see here they're showing their performance over time. They're benchmarking against the S&P Composite 1500 Aerospace and Defense Index. So there's lots of indices out there, lots of ways to describe this domain, but you see familiar names there, right? They all agree that these companies would be considered aerospace and defense. You can see how more equally weighted it is. They have 52 holdings. And if we look at the top names across both those ETFs, we see there's the big three. You have Boeing, RTX Corporation, and Lockheed Martin. That's another familiar name. These are the big three, and I pulled up revenues. It's remarkable. Their 2022 revenues are almost exactly the same for all three companies. So they're similar, although we can start digging into some of the differences here in a second. Then you have Northrop Grumman and General Dynamics Corporation. That's General Dynamics is one we're going to talk a little bit more about briefly. Now, when we look at, I thought this was interesting to take a step back, and we look at arms exporting, and we know that these firms build weapons of war, right? And when we look at the countries in the world that export the most weapons, it's the United States with 40% market share of weapons exporting. What's more interesting here is you see in the bottom, the top 10 importers of U.S. arms. Well, the Gulf Corporation Council, the GCC, they buy 35% of U.S. exported weapons, quite a few. So thought that was rather interesting. And that brings up the question, well, for these large defense companies in the United States, what percentage of their revenue exposure, or let's say their exposure in general for investors, would relate to aerospace versus defense? And this graph here from Statista breaks this down, you can see that, at least according to this source, 90% of Lockheed's exposure is defense, 65% of Raytheon's exposure is defense, and then 50% of Boeing's exposure is defense. Now, before we continue, I just wanted to ask you a couple favors. First of all, please like this video. We don't run ads, and YouTube is trying to force us to run ads, and we say no. That means we need your help to spread the message. Please like this video. It takes a second. And then consider signing up for our newsletter. You can see here it's called Analyze Weekly. If you're somebody who's a premium subscriber, you receive our premium newsletter. But this one's free, and it provides useful information on a weekly basis. One of the things I think this coming issue, we're going to look at our simple valuation ratio, which has been dropping like a rock. We're going to look at the biggest movers, the top 5 movers. So that will be in this coming newsletter. So make sure you sign up. I put a link in the description of this video at the top. So just click the link, sign up. So let's get back to talking about Raytheon. And the change to RTX was when Raytheon combined with United Technologies in 2020, not that long ago. And what they did during that merger is that they spun off 2 of United's businesses, Carrier and Otis, and then retained the 2 others, Pratt & Whitney and Collins Aerospace, to create what they say the world's most advanced aerospace and defense systems provider. And here you can see that broken down. So Collins Aerospace, it's what it says in the tin. Pratt & Whitney there for engines, and then Raytheon, you can actually break that segment down a little bit more. But you see here, this was taken from a recent investor deck, which is fairly informative if you want to know about what they do. Just pop that open, and they'll talk about how they're capitalizing on current market valuation to return capital to shareholders. So they see their shares as cheap, and then they're focused here highlighting their commercial growth. That's because when you look here at government dependence, it's pretty heavy. So this is a very nice table that you can find in their financial filings that shows the percentage of revenues coming from U.S. government, and you can see below that foreign military and foreign government, so those can be added together. And then you have commercial, so you do the math there, and it's roughly 50% or more, like 60% for government and foreign governments and military versus commercial, and apparently they're trying to boost that commercial component. Now, defense stocks are best suited for income-oriented investors seeking steady growth and rising dividends from the Fool, and then NASDAQ. They're ideal for supporting dividend growth. And then you have Yahoo Finance. Lockheed Martin is among the best defense stocks for dividend income. Well, defense stocks, what they're describing here, are defensive stocks. And a defensive stock is one that provides a consistent dividend and stable earnings regardless of the state of the overall stock market or economy. Well, that happens to be the entire thesis behind our own dividend growth strategy, which looks at dividend champions. These are firms that have not only paid, it's very important, increased their dividend for at least 25 years in a row. If they've managed to do that, then they enter an exclusive club. I think there's probably around 80 companies total in the world that have done this, at least let's say in the United States, and they're listed in our strategy. And then what we've done is we've taken that universe and then ranked them. And here you can see that in the industrials sector, remember we looked at that? In the industrials sector or industry, you have RTX, there's Raytheon there, right in the middle. So it has a lower Q score, meaning there are more attractive companies in industrials that we've chosen to invest in. But if you're an investor who's looking for quality companies and you want to have some exposure to defense companies that have a track record of increasing their dividend, then you might look at RTX and General Dynamics. You see, even though GD has a lower Q score, it's still worth looking at. The idea being here, and we've just wrapped up some research on this, that companies that have dividend champion status outperform over time because of that consistency. So stay tuned for more information on that. But one thing that came up while researching this piece is that we've ascribed a dividend champion status to Raytheon. However, when we look at dividend champions, there's also this notion of dividend aristocrats. So these are companies that the S&P 500 has assigned dividend champion status to. In other words, these are the companies they believe have increased dividends for 25 years in a row at least. Now, Raytheon used to have dividend aristocrat status until 2020 when that merger took place. And then they believe that it tainted that bloodline. Since United wasn't an aristocrat, they dropped that newly formed company in their 2021 rebalance. Now, we didn't drop them. We've manually updated the data to show a continuation for Raytheon being a dividend champion. The logic being this: if we included AbbVie and Abbott, those are just two examples, when mergers took place, and it gave that dividend, let that dividend champion status continue, and S&P did the same thing, then shouldn't we do the same thing with Raytheon? But there's only one problem, and here it is. So you can see that there's an initial dip. So if the acquired company doubled share count and dividend stays the same, did the dividend increase? Or say did it decrease? Not necessarily, because the amount that's being paid out didn't decrease. It's just the dividends per share, right? So that original decline could be explained by that. However, this second-year decline needs to be investigated. The 2020 to 2021, you see this 7% down. Why did that decline happen? So I think what we need to do here is provide some clarity, let's say additional detail around our decision to keep RTX in our own strategy. So I've sent this to an analyst for follow-up. Now, just to conclude, RTX is one of the three biggest aerospace and defense firms. If you're investing in defense, there are also ETFs that you should consider instead of trying to cherry pick a company. Now, if you consider RTX or General Dynamics, it's because you believe they will outperform that sector, and then you would benchmark that decision against a sector ETF. Now, dividend champions do outperform. That's the research that we've been doing shows that. So it would be understandable why you'd want to cherry pick, and then, of course, as I said, you could benchmark to see if you were correct or not over time. Now, the RTX dividend track record, that's in question, as I pointed out. What's important here is, what does the company believe? If they believe they still have that track record, then they're going to likely want to maintain it. That's the power of that track record, is that once a company goes down that path for 25 years, they don't want to break that track record, right? So we want to know what the company believes, so we're going to investigate that some more. For our own portfolios, RTX stock doesn't present itself as a compelling dividend growth stock or a disruptive growth stock, so it's not something that we would invest in. Now, I've put up another video here that you might be interested in. Before you watch that, please click the Analyze logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.